Now look, I'm not in the business of trying to predict what the Federal Reserve Bank is going to do because that's gambling. And I'm not in the business of trying to fight the Federal Reserve Bank because that's going to be a very painful fight. They can print as much money as they want on command. Instead, I'm in the business of understanding what the Federal Reserve Bank is going to do. That way I can allocate my money smartly instead of just throwing my money around blindly. Now, the best way for you to stay up to date on what's happening would be to actually read what the Federal Reserve Bank says, read the reports, read the raw data. That way you can make smart analysis for yourself. If you're not willing to or not interested in spending the time of actually reading the reports and listening to what they're saying, not just the headlines, but the actual reports, then the next best thing would be for you to join something like Market Briefs, which is my free financial newsletter that I created. It's a way for you to stay up to date on what's happening in the inflation, stock market, real estate market, cryptocurrency, and global economy into a fun, easy to read, and witty newsletter. I promise you, you are going to love reading Market Briefs in the morning. And if you haven't joined Market Briefs yet, what are you waiting for? It's free. So if you want to join Market Briefs for free, I'll put the link to how you can join down in the description below. So Cathie Wood is the famous investor in the ARK funds, and she tweeted this. In response to Elon Musk tweeting that a major Fed rate hike risks deflation, Cathie Wood said that deflation is in the pipeline, heading for the PPI, CPI, PCE. These are all just inflation indexes. And she's saying that from the peak of COVID, we have seen the price of a lot of things like lumber, copper, oil, and iron ore fall. And then Elon Musk responded to Cathie Wood's thread of tweets by saying, exactly, this is neither subtle nor secret. So you have the Federal Reserve Bank here saying, expect more pain ahead. We're going to continue to raise interest rates. We don't care if it's going to crash the stock market. We don't care if it's going to crash the real estate market. We don't care if it's going to crash the economy. That's what they're saying right now, that they're going to continue to raise interest rates to bring inflation down. Now you have Cathie Wood and Elon Musk saying, you got to stop with the interest rate hikes because you're going to cause deflation. You're going to cause a recession. You're going to cause a lot of pain. And these things need to be stopped by the Federal Reserve Bank. Now, you got to understand people's intentions, because if you have money in the markets, you want a cut in interest rates because that's going to cause inflation, it's going to cause a boom, and it's going to cause your assets to go up, of course. Now, if you have money on the sideline and you want to put money in the market, it's more beneficial for you to see interest rates go up because that's going to hurt asset prices and create a better buying opportunity for you. This is just from the aspect of your money. Now, if we talk about it from an economic perspective, of course, you want inflation to come down. Of course, you want to see a reset. You want to see things get actually taken care of instead of just putting a little staple or a little band-aid on the problem, because this bubble is going to continue to get bigger if we just keep inflating and inflating and inflating. It is very important to bring inflation down. That way you can save the health of our economy, but also save the health of our dollar. But if we focus in on Cathie Wood and Elon Musk's perspective, they are in charge of either investing in or creating startups. And these startups are many times very heavy on debt, which means that they use outside money to grow. Many of these startups don't have a profit, because if you make a profit, that's looked at as bad in the eyes of investors, because if you have a profit, that means you have cash in the bank that's not being invested, that's not being used, so you're not growing as quick as possible, as fast as possible. So for these startups, it is very advantageous to go into as much debt as possible, to raise as much investment dollars as possible. That way you can grow big and fast. You don't want to have a profit because that's dead money sitting in your bank account. You want to invest every dollar that you have back into yourself. Now, if you remember what I said in the beginning part of this video, who does deflation hurt and benefit? Well, deflation hurts people who have debt. Because now when you have debt, you have all this money that you owe, but now the value of your dollars are getting more expensive, which means you owe this money with more expensive dollars. Meaning your debt becomes more expensive when you have deflation. You could think of it just like when inflation happens. If you borrow $500,000 to buy a home, and then the home value goes up to $1 million because you have inflation, and your salary goes up significantly, your salary doubles, well, your mortgage payment isn't going to feel as painful because you've had more inflation and your debt is fixed. But if you have deflation, you have this $500,000 mortgage, but now your home price goes down to $250,000. Now it's much more painful, much more expensive to pay back your mortgage, especially if your salary gets cut in half as well. That's what these business owners fear, is this type of deflation, because now you're going to have to pay more money, more dollars, more valuable dollars to pay down your debt. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.